Start chapter 3. Chapter 3, as you can see on your screen here, deals with financial statements, cash flows, and taxes. We're going to talk about all the various financial statements that we should be aware of, talk a little bit about free cash flow, and also about just taxes and how taxes impact corporations and what they kind of need to be thinking about as they make decisions about projects and so on, and the tax implications of things that they do. So based on that, you can see, let me get down to the next slide here. There we go, the annual report. The annual report of a company, it basically gives you the 4 financial statements plus the notes to financial statements. And that's, as an investor, you'd look at that frequently. They come out quarterly, and the quarterly ones are shorter than the annual one. The annual one will contain a lot more information, especially in the notes and the quarterly financial statements. But the annual report itself, so annual of course implies once per year, that's the big one that's done, that the company's putting together a lot more information than they are in the quarterlies. They'll include a letter or a statement from the CEO or CFO, or some people at the top. They'll write about how the company performed over the last year. They'll talk about what some future goals are, things like that. So trying to give a big, broad perspective of what's been going on and what will be going on per their plans with the company. What are their ideas, their goals, their strategies? They won't give away everything to the competition, of course, but you should get a pretty good idea of how the company's performed and just some big picture things of what they want to do. So the financial statements are on the screen. The balance sheet is a snapshot of financial position. What are their assets, liabilities, and equity at a certain point in time? The income statement says, here's what was my revenues and expenses over a period of time. For annual, that would be a year. Quarterly, obviously every 3 months. Statement of cash flows basically says, where did the cash come from and where did the cash go, organized into 3 broad categories. And statement of equity shows how much of the company's earnings were kept and paid out as dividends, and a few other little things too. But big picture, just make sure you've got a good feel for balance sheet, income statement, statement of cash flows, and stockholder statement of equity. That's important to know what those will do for you. And so what they do on the slideshow here is they show us a little bit different example than what's actually in chapter 3. But in the slideshow, they're going to show us an example of the company called DeLeon. It's a snack food manufacturing company. They did a big expansion in 2015, and the results of the expansion have not gone well. It's been unsatisfactory. Their cash position is weak, suppliers are being paid late, and the bank is threatening to cut off credit. And the board of directors has said that's not good. Clearly, changes must be made. And I should also point out the book uses a different company called Alliance Food Products with different numbers. So it's really not a bad idea to read through that example in the book and, of course, go through what I'm walking you through in the PowerPoint. So their company's assets, so their balance sheet's right here. This is part of the balance sheet, just the asset section. And you can see here that between 15 and 16, we mentioned that they said that the cash position has not been good. You can see clearly their cash position has dropped a lot. Receivables have not quite doubled, but in the neighborhood of doubling, have gone up a lot. Inventories have gone up more than $500,000. Those are not good signs, by the way. You don't want that much receivables or inventory buildup typically. Fixed assets went up a lot. That's the gross FA as fixed assets. So you can see that they're about a $700,000 increase there. And that's because they did this expansion, so they invested in more property, plant, and equipment type assets, which makes sense that there's more depreciation because there's more assets. And then net fixed assets, you can see how those changed also between the 2 years. And total assets went up a lot. It almost doubled, but that's not necessarily a good thing. So that can be bad, and I think we'll discover that when we look at the liabilities and equity section of the balance sheets. And so you can see the accounts payable went up a lot, and they mentioned that they're falling behind on being able to pay their bills. Accruals went up a lot more than they probably really should have been. Notes payable went up $436,000. They borrowed money. Long-term debt went up by $400,000. Again, they borrowed money. So they borrowed about $800,000. Some of it was current, some of it was long-term. Their stock did not change. Common stock didn't change. That just tells you that they borrowed all that money that they grew, that they used for the expansion. And look at how much retained earnings dropped by, 203 to 32, so a big drop there. So the signs are not looking good for this company by any means. Look at their sales on the income statement. Remember, the income statement is profit and loss. Now sales went up a lot, and that's typically a very good thing. You want sales to go up, and that's evidenced by the fact that they expanded and had more sales. But their cost of goods sold, without running any percentages, just by eyeballing it, it looks like their cost of goods sold went up at a higher rate than their sales did. So they weren't quite as profitable as they were before. You can even just say that by looking at sales minus cost of goods sold. In 15, that was 600,000 roughly. In this year, it's maybe not even 500,000, 450,000, something like that. So it changed a lot, probably more like 500,000. So cost of goods sold went up at a higher rate than sales did, and we got this big other expense also that we're incurring. Total operating costs went up a lot. Not a good sign. Depreciation went up because we have more property, plant, and equipment. My EBIT is earnings before interest and tax, is what that stands for. And then interest expense is I have more interest because I borrowed more money. And then EBT is earnings before tax, my earnings before I pay taxes or incur tax expense. And you can see we had a negative tax because we had a loss. But anyway, I went from a net profit of 87,960 to a net loss of 160,176. So the expansion clearly did not work out. Just some other data. The number of shares of stock didn't change. We did not issue new stock. My earnings per share went to a big negative because I went from a net gain to a net loss. My dividends per share, I dropped the amount of dividends that I paid. Now I would have argued if we had that big of a loss, it probably should not have paid any dividends. The stock price went down a lot. Clearly investors were not very happy with the performance, and the lease payments did not change between the 2 years. The statement of equity breaks down equity into the four main categories, or really three main categories, I should say. Common stock in both the shares of stock and the dollar amount of those shares, retained earnings, and then the total equity. So retained earnings is the big one we're taking a look at here. You can see retained earnings went down because we had a net loss and because we paid out an $11,000 dividend. The statement of cash flows is looking again at cash. Where did it come from and where did it go? Sources and uses of cash, organized into three broad categories of operating, investing, and financing. Operating cash flows are cash flows that we earn through the day-to-day operations of the product that we manufacture or the service that we sell, whatever it is that we do. It's just the cash we earn by doing that, and that should be a positive for most companies. You want that to be a positive. You want it to be a positive consistently. Occasionally you may end up with a loss for some various reasons, and in this particular year we have a negative cash flow from operations. So this business makes snack cakes, and that didn't go so well for them. They lost money just by making and selling snack cakes. So what we're doing is we're taking net income of the company and we're taking out the non-cash items to get down to really a net income per cash is really what that 164, 176 is. Think of it as a cash basis income statement. And so on a cash basis, we lost 164,000 in cash just by doing our day-to-day operations. Investing, that category deals with the buying and selling of property, plant, and equipment, and we invested money into buying more property, plant, and equipment to expand our company. That's a big negative, negative 711,950. On the financing side, that really deals with borrowing money and repaying it back and dividends. We borrowed money, both long-term and short-term, and we also paid out dividends. So we had a large cash inflow from the borrowing. We used that cash, really that positive 825 was used to finance the property, plant, and equipment acquisitions and pay out dividends. So cash took a big drop. We lost, our cash balance went down by $50,000, which is part of the reason why we're having a hard time paying our bills. So just the conclusions, and I've probably already mentioned a lot of these conclusions. We lost cash from cash flow from operations because of the large negative net income. We had to borrow $836,000 to meet cash requirements, and even after we borrowed, we lost $50,000 worth of cash. So the question is, did the expansion create additional after-tax operating income? And so we're going to do a lot of formulas in this class, but they're usually not that bad. It's just a matter of knowing what the acronyms mean. So AT just means after tax. EBIT means earnings before interest and tax. So my after-tax income in 2016, right here, I can take my EBIT, what we got from the income statement, times 1 minus the tax rate. And it's very common that we use a 40% tax rate. In reality, the corporate tax rate is very close to 40%. It's anywhere between, depending on the size of the company, about 35 to 39 is kind of the norm, but most finance books just round to 40 just to make it easy. So we usually see the 40% tax rate in finance books. And so you can see the after-tax operating income was actually negative of 78,569. In 15, it was a positive 114,257. So this expansion resulted in a loss, a big drop in additional after-tax operating income. We lost on that deal. That did not turn out the way they planned. NOWC is net operating working capital. It says here, what effect did the expansion have on net operating working capital? And you can see that current assets minus current liabilities minus notes payable is my definition of net operating working capital. So it's just current assets minus current liabilities minus notes payable. And you can see here that in 16, by looking at the numbers from previous slides, current assets was we just take the 7282 plus 632 plus 160 plus 1287360. Those are my three current assets. I subtract current liabilities of 1,655,68. My notes payable was 636,808. So my net operating working capital did go up. It was 913,042 in 16, a small increase from the previous number of 842,400. Just some other numbers to kind of look at between the 2 years. Sales clearly went up. That was good. However, we still lost a lot of money. My after-tax operating income went from a positive to a negative. My net operating working capital did go up, so that was a good sign, but my net income took a really big drop, 87,960 to a negative 160,176. What was the effect on free cash flow? So just to define what free cash flow is basically cash flows that are generated after a company pays for its expenses and pays for any capital expenditures needed to maintain current operations. So extra cash that a company has just after all the bills are paid and after any needed property, plant, and equipment assets just to maintain your current position are acquired. So just know with property, plant, and equipment, things wear out, things break down. So as you have machinery that just becomes obsolete or wears out and needs replacing, you need to replace that. So if you just kind of break down the formula, FCF is free cash flow equals your EBIT, earnings before interest and tax, times 1 minus the tax rate. So that tax affects your EBIT. We add back depreciation and amortization because those are non-cash items. So on the income statement, whenever you see depreciation and amortization, those are non-cash expenses. So we add those back because there's no cash involved with those. So we take the sum of those, then we subtract capital expenditures, anything needed to purchase property, plant, and equipment assets to maintain our current position, plus the change in net operating working capital. So how did net operating working capital change from 1 year to the next? And that is my free cash flow. And we have a large negative. You want that to be positive. Okay, so you want that to be a positive number. Now, you can have the occasional year when it's negative. I mean, that can happen, especially in a big expansion year. And so, that's okay to have a negative free cash flow in an expansion year, but you need to show that that expansion will generate future positive cash, which as of today it does not. So, just some other methods of evaluating performance beyond financial statements. So that was really just kind of a good, what we just did there was kind of just, why you look at financial statements, what each of the financial statements will do for you. It's important to know those. It's also important to just kind of know what kind of conclusions I can maybe draw by looking at financial statements, especially when I kind of know what's going on, with the company. They told us that they're expanding. They kind of gave us a clue that the numbers would be different between the 2 years. But some other ways to just evaluate performance of a company, and this is a way that a manager would be evaluated by the board of directors or top executives of the company. You can see here it says accounting statements are insufficient for evaluating manager performance because they do not reflect market values. Financial statements are historical in perspective. They show you the results of the past, not the future. So they're basically saying, here's how we did this last year. They're historical. So some other ways to measure and include market values are MVA, which is market value added, and EVA, which is economic value added. And MVA is the difference between the market value and book value of a firm's common equity. So what's the price of the stock on the market today minus its book value? The book value is the equity in the company on the financial statement. So that number on the statement of equity, that's the book value of a company. That difference, if it's if the market price is much higher than book value, that's a positive and a good MVA. EVA is an estimate of your true economic profit for a year. And the way to try to come up with that number is to take your EBIT times 1 minus the tax rate times 1 minus T minus total invested capital times your cost of capital. We've not gotten into what the cost of capital is yet, but we will. Okay, so just basically, just with the numbers they gave us, the market value added went from a positive in 15 to a large negative in 16, and the statement there, shareholder value has been destroyed, is probably an understatement. It did not go well. So EVA and MVA, if EVA is positive, then after-tax operating cost is greater than cost of capital needed to produce that income. Positive EVA on an annual basis helps to ensure that MVA is positive. MVA is applicable to the entire firm. EVA can be calculated just on a division. Some really big companies like a GE or a Disney actually have several divisions within them. And so what's beneficial then is that you can do an EVA calculation on a particular division of a company. Because the big companies, when they have divisions, there's usually a person or a small group of people that oversees or is responsible for the performance of that division. Does Deleon pay its suppliers on time? Probably not. Their cash balance went way down. AP, their accounts payable, increased a lot, 260% over the last year, while sales went up by 76%. Now, if their AP went up at the same rate of their sales, that's acceptable. As sales go up, other things will organically go up with it. So if we said AP went up by 76%, you'd have been, yeah, okay, that makes sense, or something near that. But 260% is just bad, very, very bad. And if they go too long without paying suppliers are going to cut them off and say, we're not selling anything to you until you pay us up front, which could kill the business if you don't have the ability to buy on credit. Does it appear that the sales price exceeds its cost per unit sold? No. The negative after-tax operating income and decline in cash shows that they are spending more on operations than it's taking in. What if Deleon's sales manager decided to offer 60-day credit terms to customers rather than a 30-day credit term? So think of it from the perspective of Deleon selling to their customers. And let's just say the current terms are 30 days that we'll sell you to on credit and you pay us within 30 days. If they offered 60 days, what would change? And that's what's kind of nice to know is, we've got this base case here of this company has not done very well. And of course, the board is looking at this going, how can we change it? And that's where you just start to ask a bunch of questions. If we implement this policy, then what? And if we decide that, from a cash flow perspective, offering longer time to get paid back isn't good, clearly, but if we are going to try to increase sales overall, it would help us just make more sales, because if most of our competitors offer 30-day terms and we turn around and say to our customers, those guys across the street will only give you 30 days, we'll give you 60. So therefore, there's an incentive to buy from us because our customers have a longer time to pay us back. AR would go up and cash would go down. However, if the competitors don't match it, we'll sell more. Okay, so in the short term, inventory and fixed assets will rise. to meet more sales, and AR will go up and cash will go down because we'll have to finance that production in the short term. But in the long term, we'll get more sales, more cash collections, and the company's cash position will improve. So that's a possible item that they could potentially think about doing. How do they finance their expansion? With external capital. We showed that because their equity didn't change, their common stock number did not change. Their notes payable and their long-term debt both went up, and so they borrowed all of the money for the expansion. Would DeLand have required external capital if they had broken even in 16? Net income was 0. Actually, still yes. The company would still have to finance its increase in assets because with those extra sales came the need to have extra inventory. They had to buy raw materials to make their snack cakes, and probably had more people running machines to pay them, and so on. What happens if they depreciate fixed assets over 7 years as opposed to 10 years? So depreciation does not impact the physical asset itself. It does impact how much you record as depreciation, though. And so if you take depreciation and do it over 7 years as opposed to 10, your depreciation per year will go up. It'll be higher, which means net income would go down, which means tax payments would go down, which would help your cash position. So that would be an option for them, would be to accelerate depreciation so that they can reduce cash paid on taxes and save on some cash for today. You're kind of just postponing the payment of your taxes when you do it that way. Okay, new topic. Now it's all about the federal tax system, both from the individual and corporate perspective. And we're just doing this at a very high level. Clearly, you can take an entire class or classes based on both the corporate and personal taxes. We're just looking at this from a very high level perspective, more of an awareness issue. Just know that the tax structure in our country is progressive, meaning the higher the income, the higher the rate of tax that you pay. Corporations begin at 15% and go to 35% for corporations with income over 10 million. Although corporations with income between 15 million and 18.3 will pay 38%. So that's why I mentioned before, and I said 39 before, and I should have just said 38. It ranges between 15 to 38 depending on your size, but our books will typically just use 40% because this is a nice even number to round with. Several states also have a corporate and personal tax rates. And so that says right here, potentially around 5%. Some states have none, some have a really high number, some a low number. Just depends. 50 states with 50 different answers there. For individuals, rates begin at 10% and rise to almost 40% for single individuals with incomes over $413,000 and married couples filing jointly at $468,000. Of course, also states have state income tax. Also, not every state, but most states do. South Dakota does not. Tax treatment of various uses and sources of funds, depending on where the money came from and where it goes, it may be a deduction or it may be taxable as income. Interest paid for corporations is deductible. Okay, so a corporation, as long as it's paying interest on anything, it's tax deductible, and that's a really big deal, and that's going to come into play throughout our class because that will help ease the cost of borrowing. Okay, so for corporations, pretty much any interest paid is tax deductible. For you and I as individuals, different story. The only interest that we can deduct from our tax return is the interest on our primary home. That's it. Okay, that's it. So just whatever home that we live in is our primary residence. And there's a test based on how much time you spend in that home. If you had more than one home, for example, that had loans, only one of them would count as your primary residence. And that's the only home you can deduct interest on your tax return. The only interest that can be deducted. Corporations can deduct all interest. So big difference there. Interest earned. Interest earned is usually fully taxable for both individuals and corporations except for municipal bonds, and those are not taxable for both corporations and individuals. So if you're a corporation or an individual that owns a municipal bond, any interest you receive on that municipal bond is not taxable. A municipal bond is a bond issued by a local government, state and local governments. So that include a school district, a city, a county, a state. Whenever they issue a bond to pay for something, whatever it is, that interest is not it's not taxable to whoever receives it. Dividends paid for corporations are paid out after tax income. Corporations themselves are double taxed. We mentioned that in Chapter 1. So the corporate entity is taxable itself, and dividends are paid with after-tax dollars. And whoever receives that dividend has to pay tax on it again. So that's the double tax. Most on dividends received, most investors pay 15% to tax. Investors in the 10 to 15% bracket will pay 0% on qualified dividends. Taxpayers in the 39.6% bracket pay 20% taxes on dividends, which means if you're a high wealth individual, it makes receiving dividends a good thing because you're not paying as much tax on those as you are with your other income. Dividends are paid out of net income. I mentioned the double taxation part. Corporations that own stocks, they can actually exclude part of the dividends because otherwise there'd be a triple tax. So let's just say you're a corporation that owns stock of another corporation, which is actually very common. When you receive the dividends, you have a 70% exclusion. Otherwise there'd be a triple tax because if you're a corporation and you receive dividends, now that becomes a part of your taxable income, which increases your net income, which increases your tax bill. So there's a 70% exclusion for corporations. Okay, so that was the tax code, Chapter 3. That was a really, really high level of the tax code, FYI. But the key thing to remember for corporate finance is that interest deductibility. That when a corporation pays interest, it can deduct all of that, which makes borrowing money sometimes more attractive as a way to raise capital for a corporation than does issuing stock.